2025 is turning Florida's housing market upside down, and that's because dozens of cities that once felt like safe bets are now about to nosedive hard in price. If you're thinking about buying property in the Sunshine State, these are the places you need to absolutely avoid. Palm Bay, located along Florida's Space Coast, has seen rapid growth over the past decade, but cracks are starting to show. The city's population has surged to over 125,000, driven by affordability and proximity to tech jobs in nearby Melbourne. But that boom led to overbuilding. Between 2020 and 2024, residential building permits nearly doubled, and now the market is oversupplied. Home values rose by over 40% during that stretch, but have stagnated in early 2025. With a median home price around $315,000, many buyers are struggling to qualify amid high interest rates and tighter credit. Adding to the pressure is the job market. Palm Bay relies heavily on aerospace and manufacturing, sectors vulnerable to federal budget shifts. Layoffs at local contractors like L3 Harris and embattled small businesses have increased unemployment claims. Rising insurance premiums due to hurricane risk are also driving buyers away. The local government is attempting to attract new industries, but infrastructure hasn't kept pace with growth. If buyer demand continues to cool while inventory climbs, prices could take a hit, especially in outlying subdivisions built on speculation. The city's population growth is also slowing, with fewer people moving in compared to previous years. This shift reduces demand and puts downward pressure on prices. Additionally, recent construction booms have flooded the market with new homes, creating a surplus that further drives prices down. Palm Bay's affordability compared to other Florida cities is starting to erode, and with economic uncertainty lingering, many experts predict that home prices here could continue to fall through 2025. For homeowners and investors, caution is warranted as Palm Bay transitions from a seller's market to a buyer's market. Daytona Beach, Florida has long been known as the world's most famous beach, famous for its motorsports events like the Daytona 500 and its vibrant tourism industry. As of 2025, the city's population stands at around 69,000, but the local housing market is facing significant challenges that could lead to price declines this year. Over the past decade, Daytona Beach experienced steady growth fueled by affordable coastal living compared to bigger cities like Miami or Tampa. However, median home prices have surged from approximately $220,000 in 2019 to nearly $350,000 in 2024. While this increase initially reflected rising demand, it has outpaced local wage growth. The median household income is roughly $45,000, well below the state average, making homeownership increasingly out of reach for many residents. Economically, Daytona Beach relies heavily on tourism, hospitality, and retail, sectors vulnerable to economic downturns and seasonal fluctuations. This dependence limits stable job growth and wage increases, placing additional pressure on the housing market. The city also faces infrastructure challenges. Traffic congestion on key routes like International Speedway Boulevard is worsening, and public transportation options are limited, reducing overall accessibility. Additionally, Daytona Beach is exposed to hurricane risks and flooding, which have led to rising homeowner insurance premiums, squeezing budgets further. Environmental concerns are particularly important in a coastal city, and rising sea levels threaten long-term property values. The rental market is also softening, with increased new construction outpacing renter demand. Investors who entered the market during the boom are now beginning to sell off properties, increasing inventory levels and driving longer selling times. With mortgage rates remaining relatively high and economic uncertainty increasing, Daytona Beach's housing market faces a real possibility of price corrections in 2025. especially for entry-level and mid-priced homes. Port St. Lucie has been one of Florida's fastest-growing cities for years, but 2025 could mark a turning point. With a population nearing 240,000, the city has attracted retirees and remote workers seeking affordable housing along the Treasure Coast. But prices are no longer affordable. The median home value now sits at $395,000, up nearly 60% since 2019. The problem? Local wages haven't caught up. Port St. Lucie's economy is driven by healthcare, education, and retail, sectors that haven't seen major pay increases. Mortgage delinquencies have ticked up in 2025, especially in new developments where buyers stretch their budgets. The rental market has also softened, with vacancy rates rising in apartment complexes built during the boom. A second issue is environmental risk. Port St. Lucie is vulnerable to flooding and sea level rise, and FEMA's updated flood maps have placed thousands of homes into new risk zones, increasing insurance costs. With construction continuing and demand softening, there's a growing chance the local housing market becomes overextended. A correction may not be as severe as in speculative markets, but a gradual slide in home prices looks more likely by year's end. Cape Coral was one of the poster children of the 2008 crash, and it's showing signs of déjà vu. This canal-filled city in southwest Florida saw explosive growth during the pandemic as buyers flooded in from out of state. But in 2025, the tide is turning. The median home price has hovered around $420,000, and inventory is rising fast. New construction is everywhere, but many homes are sitting unsold as interest rates and insurance premiums spike. Cape Coral is particularly exposed to flooding and storm surge. Hurricane Ian devastated parts of the city in 2022, and rebuilding has been slow and expensive. Homeowners have been hit hard by insurance hikes, with some paying over $5,000 annually. Known for its extensive canal system and appeal to retirees and second home buyers, Cape Coral saw median home prices surge over the last decade. However, recent data reveals that prices are now starting to dip. The median home price in 2025 has declined by approximately 4% compared to the previous year, settling near $385,000. This decline signals a shift from the aggressive appreciation seen in prior years. Several factors contribute to Cape Coral's cooling market. First, rising mortgage rates have significantly impacted affordability. Many buyers who fueled demand in recent years are now sidelined by higher borrowing costs, reducing the pool of qualified purchasers. This has caused days on market to lengthen. Homes are now taking around 70 days to sell, up from just over 40 days 2 years ago. Additionally, Cape Coral's local economy, while growing, has not matched the pace of real estate development. The city relies heavily on tourism and construction, sectors vulnerable to economic slowdowns and supply chain disruptions. Wages in the area remain modest relative to home prices, making it harder for average families to compete with investors or wealthier buyers. Another pressure point is the recent surge in new home construction. Overbuilding has led to a glut of available properties, pushing sellers to lower prices in order to attract buyers. Meanwhile, some homeowners who purchased at peak prices are now reluctant to sell at a loss, further limiting market turnover. All these factors combined indicate that Cape Coral is moving towards a buyer's market, with home prices expected to continue softening through 2025. Sellers may face tough negotiations, while buyers can potentially take advantage of more favorable pricing and less competition. Tallahassee, Florida's capital city, is known for its political significance, college town atmosphere, and rich history. With a 2025 population hovering around 196,000, it has been a steady but slow-growing city compared to other parts of the state. Despite its relative stability, the housing market in Tallahassee is showing signs of strain that could lead to price declines this year. Over the past several years, Tallahassee's housing prices climbed steadily, with the median home price reaching about $350,000 in 2024, up nearly 40% from 5 years prior. This increase was initially driven by demand from university staff, government employees, and retirees. However, wage growth in the region hasn't kept pace, with the median household income near $53,000, well below the median home price growth. This disparity has created affordability issues for first-time buyers and middle-income families. The local economy is heavily tied to state government jobs and Florida State University, which provides some insulation but also limits diversification. Job growth outside the public sector has been sluggish, particularly in industries that pay higher wages. This makes it difficult for many residents to keep up with rising housing costs, leading some to rent longer or move to more affordable surrounding areas. Another challenge is Tallahassee's infrastructure and transportation system. Public transit options are limited, and traffic congestion has increased on main thoroughfares such as Thomasville Road and Capitol Circle. These issues can reduce the city's attractiveness, especially for younger professionals considering relocation. Environmental factors, including occasional flooding during heavy rains, also raise concerns for homeowners. Insurance premiums in flood-prone areas have risen, adding to the cost of homeownership. With mortgage rates still elevated and new housing developments adding supply, Tallahassee's housing market is poised for a potential correction in 2025, particularly for lower and mid-tier homes that have seen the largest price jumps. Kissimmee's housing boom was built on one thing: tourism. Located just minutes from Disney and Universal Studios, the city turned into a short-term rental goldmine during the pandemic. But now that tourism demand has stabilized and Airbnb revenues are falling, that same market is unraveling. More than 40% of homes in some Kissimmee neighborhoods are owned by investors or vacation rental hosts. As demand cools and regulations increase, many are exiting. The median home price has climbed above $360,000, yet the typical household earns just $52,000. Renters are struggling too. Over half of them spend more than 35% of their income on housing. Kissimmee's infrastructure isn't keeping up either. Traffic congestion on US 192 is brutal, and recent school district performance has slipped. New zoning laws in 2024 allowed higher density construction, but they also triggered gentrification and rent spikes. Now, with more units flooding the market and fewer out-of-state buyers arriving, sellers are slashing prices. Unless tourism rebounds sharply or locals see major wage growth, Kissimmee's housing values may plunge in the next year. Northport, Florida, has been one of the fastest-growing cities in the state over the past decade, largely fueled by affordable land, new housing developments, and retirees relocating from more expensive coastal areas. Nestled in Sarasota County, Northport offers a suburban lifestyle with access to nature preserves and a slower pace of life compared to nearby urban centers. However, as we move into 2025, the city's housing market shows clear signs of strain, suggesting a potential crash in home prices. The rapid expansion has brought challenges that could reverse the upward trend in real estate values. For starters, the city's infrastructure is struggling to keep pace with growth. Roads are congested, public services stretched thin, and there has been insufficient investment in schools and healthcare facilities to meet the rising population demands. These growing pains are leading to increased dissatisfaction among residents and prospective buyers. In addition, Northport's affordability edge is shrinking. Median home prices have climbed to approximately $380,000, up nearly 25% in just 3 years. For many local buyers, especially younger families and first-time homeowners, this surge is becoming unsustainable. Combined with rising mortgage rates nationally, demand is starting to cool, leaving more homes lingering on the market for longer periods. Climate risks also play a role. Northport is vulnerable to hurricanes and flooding, and insurance premiums have surged. adding hidden costs for homeowners. These risks have made lenders and buyers more cautious, further slowing the market. Moreover, a significant portion of Northport's growth was driven by speculative investment, with many properties purchased as second homes or rentals. As the rental market softens and investor confidence declines, some of these properties are now being offloaded, increasing supply and driving down prices. While Northport remains a desirable location in many ways, the combination of strained infrastructure, affordability challenges, and climate-related risks is poised to pressure its housing market in 2025. Buyers may find more leverage, and sellers might have to adjust prices downward to close deals. Ocala became an unlikely real estate hotspot during the pandemic. Its location in Central Florida and low base housing prices made it attractive to buyers priced out of bigger cities. But the surge was too fast. Home prices rose from around $180,000 in 2019 to nearly $290,000 in 2024, a 60% jump, but local incomes didn't keep up. The median household income in Marion County is still under $50,000, making housing affordability a major concern. Much of the job growth here has been in low-wage sectors like warehousing, elder care, and retail. As a result, many new residents are now stretched thin financially. Ocala's infrastructure hasn't kept pace either. Traffic is worsening, and water systems are strained by the influx. Schools are overburdened, and hospital capacity is nearing its limits. Meanwhile, builders have flooded the area with new inventory, especially in sprawling subdivisions on the outskirts of town. Foreclosure filings rose nearly 18% year-over-year in early 2025, signaling that some buyers are already underwater. As mortgage rates remain elevated and demand tapers off, Ocala could be in for a sharp housing market correction. Jacksonville, Florida, the largest city by area in the continental United States, has long been considered a growing real estate market with plenty of opportunity. Its sprawling suburbs, vibrant downtown, and access to beaches attracted many new residents over the past decade. However, 2025 is shaping up to be a challenging year for Jacksonville's housing market, with housing prices under pressure. The city's population remains around 900,000, but recent shifts show demand softening, particularly in suburban and outlying neighborhoods. Jacksonville's median home price sits near $340,000, a rapid increase from just over $250,000 5 years ago. Yet median household income hovers around $60,000, creating an affordability crunch. The job market, while diverse, from logistics and finance to military and healthcare, has shown signs of stagnation, especially in middle-income sectors. Adding to concerns, Jacksonville faces infrastructure challenges, aging roads, traffic congestion, and underfunded public transit. School quality varies widely across districts, and crime rates have ticked upward in several neighborhoods. Builders have also been aggressive, leading to rising home inventories and longer selling times. Many investors who drove the post-pandemic boom are now pulling back, concerned about price corrections and rental market softness. With mortgage rates still elevated, buyers are cautious, and some existing homeowners are considering downsizing or relocating. Additionally, Jacksonville faces growing concerns related to infrastructure and urban sprawl, traffic congestion, and underfunded public transit limit accessibility, particularly in the expanding suburban neighborhoods where most new homes are built. This detracts from the city's overall appeal, especially to younger buyers seeking walkable communities. The city is also grappling with increased flood risks and rising insurance premiums due to its coastal location, which has made some buyers hesitant. Combined with an uptick in foreclosures and short sales in some lower-income neighborhoods, these factors point toward a softening market. Despite ongoing downtown revitalization projects and investments in technology and education sectors, Jacksonville's housing market faces headwinds in 2025. Sellers may need to adjust expectations, and buyers could find more negotiating power as the market cools. While Jacksonville's broad economy provides some buffer, the combination of affordability stress, increased supply, and economic uncertainties makes a housing price drop likely in 2025. Bradenton, nestled along Florida's Gulf Coast, has been a popular retirement and vacation destination for decades. But recent years have revealed cracks in the market's foundation. With a population around 60,000, Bradenton's housing prices climbed sharply to a median of roughly $380,000 in 2024, an over 50% increase in just a few years. Unfortunately, local wages haven't kept pace. The median household income is about $55,000, far below what's needed to comfortably afford the typical home. The city's economy leans heavily on tourism, healthcare, and retail, all vulnerable to seasonal fluctuations and economic downturns. The influx of retirees has increased demand for certain housing types, but affordability problems have pushed younger families and middle-income workers out of the market. Infrastructure struggles, especially traffic congestion on US 41 and limited public transit, have worsened quality of life. The area also faces environmental challenges. Rising sea levels and flooding threaten coastal neighborhoods, raising insurance costs and long-term risks. Additionally, Bradenton's rental market is tightening, forcing many to consider home ownership at inflated prices they can't sustain. Foreclosure activity has ticked upward recently, suggesting some homeowners are feeling financial strain. Local efforts to diversify the economy and invest in downtown revitalization are ongoing but unlikely to reverse the housing market pressures in the near term. With demand plateauing and inventory increasing, Bradenton's housing market appears ripe for correction in 2025. Lehigh Acres, a sprawling community in Lee County, was built largely as an affordable housing alternative during the 1980s and 1990s. It saw a boom during the pandemic as buyers fled more expensive coastal cities. However, this growth has exposed long-standing issues. Lehigh Acres' median home price surged from under $200,000 in 2019 to nearly $330,000 in 2024, while the median household income remains below $50,000. This disparity has put pressure on affordability and created a market vulnerable to correction. Unlike more established cities, Lehigh Acres lacks substantial economic drivers, relying mainly on retail, construction, and some healthcare jobs, which tend to be lower paying and less stable. Infrastructure is a major problem. Roads are often in poor condition, and public transit options are minimal. This hinders commuting and deters some buyers. The area also faces environmental concerns, including flood risks and water quality issues that impact desirability. With a high proportion of investor-owned properties and speculative buying during the boom, many homes are now sitting empty or are being flipped quickly, increasing market volatility. Foreclosures and distressed sales are rising, signaling weakening demand. The rental market is softening as well as more units come online amid slower population growth. Without new economic development or infrastructure investment, Lehigh Acres is positioned for a notable housing price drop in 2025. Sarasota is known for its art scene, beaches, and affluent retirement community. While it has long been a desirable place to live, the housing market is showing signs of strain heading into 2025. The city's population hovers near 58,000, but the broader metro area swells with seasonal residents and tourists. Median home prices have soared past $550,000, a steep climb from under $400,000 just a few years ago. However, the median household income lingers around $65,000, meaning many locals are priced out. The local economy depends heavily on tourism, healthcare, and service industries, sectors that offer limited wage growth. Infrastructure is strained, with traffic congestion on key corridors like US 41 and I-75 impacting commutes. Environmental risks such as hurricanes, flooding, and rising sea levels are increasing insurance costs and reducing long-term buyer confidence. The rental market is tight but not booming, as high prices limit new construction and push some residents to look elsewhere. While Sarasota's cultural amenities and natural beauty remain strong draws, affordability challenges and limited economic diversification are cooling demand. Investor interest has waned after rapid gains, and some speculative buyers are exiting, adding to market supply. With rising costs and economic headwinds, Sarasota's housing prices may see a downward adjustment in 2025. Palm Coast, located along Florida's northeastern Atlantic coast, has been a magnet for retirees and families seeking affordable coastal living. With a population nearing 90,000, Palm Coast's growth was rapid during the 2010s, but signs of slowdown are clear by 2025. Median home prices climbed from about $260,000 in 2019 to roughly $370,000 in 2024, driven largely by demand during the pandemic. However, local incomes have lagged, with the median household income under $55,000, creating affordability challenges for many. The city's economy is heavily service-oriented, with tourism, healthcare, and retail dominating. While Palm Coast benefits from beautiful beaches and natural parks, infrastructure investment hasn't kept pace with growth, leading to traffic congestion and limited public services. Flooding risks and storm damage are rising concerns due to climate change, impacting insurance premiums and future buyer confidence. Additionally, the rental market is softening, as increased home prices push many to consider renting longer term, but supply is growing faster than demand. Speculative buying has slowed, and homes are spending more time on the market. Although Palm Coast remains appealing for its coastal lifestyle, these economic and environmental pressures set the stage for a housing price correction in 2025. Apopka, part of the Orlando metropolitan area, is known for its suburban appeal and proximity to Central Florida's theme parks and job centers. Its population is just over 55,000, with steady growth over the last decade. However, by 2025, Apopka's housing market is showing signs of strain. Median home prices have surged from under $300,000 5 years ago to around $420,000 today, outpacing local wage growth. The median household income remains near $60,000. The city's economy relies on construction, retail, and service industries, many of which pay below average wages, limiting affordability. Infrastructure development has struggled to keep up with rapid population growth, resulting in traffic congestion on key roads like State Road 436 and 429. Schools are mixed in quality, prompting some families to relocate to neighboring districts. Additionally, rising insurance costs due to Florida's increased hurricane activity weigh heavily on homeowners. The influx of investors buying properties to rent or flip during the housing boom has led to higher inventory levels and longer selling times. With mortgage rates still relatively high and economic uncertainty looming, demand is softening. Without new economic drivers or infrastructure upgrades, Apopka's housing prices are vulnerable to a correction in 2025. Pensacola is poised for a housing crash in 2025, and not enough people are talking about it. Located in Florida's Panhandle, this historic coastal city has long been popular for military families and retirees, thanks to nearby Naval Air Station Pensacola and affordable living. At least it used to be. In the last 5 years, Pensacola's home prices surged nearly 60%, with the median price now approaching $330,000. That might not sound like much compared to Miami or Tampa, but it's a huge jump for a city where the median household income is still under $60,000. The problem is that growth wasn't fueled by strong wage gains or a boom in high-paying jobs. It was driven by out-of-state investors and remote workers. With interest rates higher and those remote buyers now pulling back, demand has softened significantly. Local real estate agents have reported a sharp rise in price reductions, and homes are sitting longer on the market than they did even during the 2020 lockdowns. Pensacola also faces environmental risks that threaten long-term housing stability. Coastal erosion, hurricane exposure, and flood risk are all significant, especially in low-lying neighborhoods near Escambia Bay. FEMA flood insurance premiums are rising fast, further eating into affordability. While tourism and military spending provide some economic cushion, they won't offset the growing pressure from inflation, insurance costs, and stagnant wages. For buyers banking on appreciation, Pensacola might be entering a dangerous stretch. Unless prices are correct, locals could find themselves stuck in properties that lose value before they gain. Click the video on the screen for more information on housing crashes in cities around the country.